Okay, good morning or good afternoon, and welcome to our webinar to introduce our new complimentary CDFI Performance and Risk Management Quarterly Report. My name is Jeff Rigsby. I'm the President and CEO of CB Resource, and I'm joined today by Bob Jones, who's the Executive Director of our Community Development Performance Group, and we'll be jointly presenting today's overview of the CDFI Performance and Risk Management Quarterly Review. First, I do want to take this opportunity to thank you all for taking time out of your busy schedule to join us. In our invitation, I think we probably put it might run an hour, but we'll certainly probably run closer to 40 minutes or so. It really is to provide a good overview of the tool and answer any questions if they come up. And then for those of you who may not be familiar with CB Resource, we are based in Southern California, Irvine, California, to be specific. We specifically serve community banks across the country. We have over 400 active clients in approximately 38 states. I know that changes a little bit from time to time. We do three things. We do enterprise risk management, strategic planning, and capital planning as well. And what makes it unique as far as how we deliver that, it's how we integrate and synchronize risk and performance-based priorities into a common application, into a common system. So that's a little bit about us. So with that said, before we get started, let's just talk a little bit about getting the most out of our session. Should you have any questions, feel free to use the chat mechanism in Zoom. We will also provide you with this presentation, and we are also recording the presentation, and we will have a little bit of time for questions and answers at the conclusion of today's presentation. As far as what I'd like to cover today is just talk a little bit about what is the purpose of the report, an overview of the report, summary of some practical applications, so how we see in the report being used, do a deeper dive into the key components, and literally walk through it page by page. I hope all of you have your copy of your report with you. And if not, we'll make sure you get that really soon. And if you do want a copy of the presentation or the recorded version, feel free to just ping me a note via email or directly through Zoom. So Bob, you ready to get this show on the road?
Absolutely, Jeff. Glad to have everyone with us this afternoon. Should be an informative session at a time of great turmoil and risk, so couldn't be more appropriate.
Great. Thanks, Bob. So just a quick, as we look at this whole report mechanism, it really is designed specifically as a custom report that encompasses CDFI banks, but is designed specifically for your bank in your confidential use only. The purpose of the report specifically is to provide bank management directors bank performance and risk-based insights as compared to CDFI chartered banks. And with that, it provides a CDFI focused basis for analysis and hopefully what may lead to better informed decision making. The performance and risk indicators illustrate trends in your relative level of financial impact and the movement of critical risk factors. So with that said, it's always nice to know how you can best use a report. So we did want to talk a little bit of what is the practical application, and you can see my buddies there on the right that, you know, it's all well and good to have this report, but what's the practical application of it? These are some of the ways that we see the report being used on a recurring basis. It's certainly an effective tool for the senior team to really review both your performance and risk priorities in a very comprehensive fashion. Minimally, it will support good dialogue. It will enhance or be a companion piece to other data-driven analytics that you may use. And ultimately, it may enhance your decision making. For those of you who are ESIP recipients, you will be getting more involved in how you're reporting what's going on with ESIP and the deployment of such. But this provides really an interesting ad hoc ESIP tracking and reporting mechanism. And I'll talk about this in my last bullet. This is a standardized report. It's a complementary report. It's being made available to every CDFI chartered bank. But with that said, if you find you like the look and feel, but that there might be a way you'd rather use it or customize it in some form or fashion, feel free to take us offline. There probably would be some sort of modest cost to that. But the important thing is that this report is designed to be actively used. And continuing to look at some other practical applications, it's really ideal. This report is an abstract. It's something that we pulled through our ERM system, through our capital and strategic planning analytics. So it's kind of an amalgam. It's an efficient composite of a lot of tools that we have internally. But I think you may find it to be a very practical tool that you might want to use for board dialogue, whether it goes into your board book, whether you might use it as a quarterly review at the audit committee, or if you have a risk committee, it works for that. It's a great ALCO supplement as it relates to the business of the bank. If you do your own strategic planning, it's a great SWOT tool, especially focusing on strengths and weaknesses and providing additional situational analysis as it relates to your bank. It is a great ERM. If you have an enterprise risk management system, then this is a great supplement to that. To the extent you want to use it for stakeholder communications, those stakeholders can be regulators, and it provides a useful way of showing one mechanism that you use to integrate both your performance and risk priorities, as well as tracking the movement of risk. It can also be used for shareholders or key customers. And lastly, anytime you're looking at either policy, goal, or benchmark considerations, it's very useful for that. So just wanted to put that up front. It's got a very good shelf life. You probably look at a lot of different reports for different things. But to my knowledge, this is the only report that really integrates performance and risk priorities of CDFI banks, but makes it a personal report that no one else can see the way you see your bank. This is a confidential report, and this is designed specifically for your use, but we are aggregating CDFI information to get there. And before we go into what's in there, Bob, any thoughts when you think of, and for those of you that may not know Bob recently retired as the president and CEO of United Bank in Alabama, one of the really highly regarded and noteworthy CDFI chartered bank. But Bob, when you think about analytics in general and impact and performance, any thoughts, as we dive into walking through the report that you'd like to share?
Yeah, Jeff, I think as you alluded to or mentioned, as a CEO in a bank or a member of the executive team, you have access to a lot of data. And it almost gets to the point where you find yourself in analysis paralysis as you get all these things and you're trying to bring it together in a cohesive view of how the institution is performing. As a client of CB Resources, before I came on board with Jeff and the team, I use these tools extensively in the management of the bank, and I found them extremely helpful because as you go through the report, you're going to see the color coding, which seems fairly simple to consider, but it allows you to focus in on areas with laser attention to areas of improvement or areas that you want to celebrate in terms of the performance of the bank. I've said this many times and have been on record within the CDFI community and in banking in general. In my decades-long career, I can't recall a time where there were so many moving factors that bankers have to consider right now. It's a dynamic situation. I haven't checked the news releases, but we may have heard what the Fed's move was. They were having a press release at 2 Eastern. But we know that we're in a period of rising interest rates, which many of the customers and bank management teams really have not experienced before, and how balance sheets perform in those sort of dynamics. There's a great amount of debate whether we're in a recession or going in a recession or how deep the recession will be. We'll soon know about that. And it's not only that, but the disruption in supply chains and customer behaviors. And, Jeff, I think we've talked with a number of client banks that in past years, human capital was not on the radar. And now it's in the top 2 to 3 risks that institutions are facing. So it's a target rich environment when we look at risk, and a tool like this can help bring focus around that. And the frequency of the reporting I have found to be very helpful to keeping your eyes focused on it, because frankly, no institution can afford to sit idly by. One other thing I would comment on, particularly for the ESIP banks, it's a phenomenal opportunity. It is an institutional game changer. For so many years within the CDFI world, we fought for two things. One, regulatory understanding and capital and liquidity. Well, COVID gave us liquidity and Treasury's given us capital. But with great opportunity can come great risk. And in a period of uncertainty, these are times that management teams have to be very alert and have a strategy and monitor that strategy and be prepared to make adjustments when the indicators require that. So I think, Jeff, that's kind of my thoughts as we get into it. And I think it's a very useful tool, and I encourage any of the participants that are receiving it to delve into it deeply. So thank you, Jeff.
Great, great. Well, let's go ahead and dive in. And I really look at this as an opportunity to just walk through the report and review it as that practical tool that it's designed to be. I do want to comment, to the extent that each of you find it useful in some form or fashion within your own organization, if there's something that you think it's zoning in on, but perhaps we haven't quite gotten it on target, our mission in life is to provide useful information. That is what we do. We're data aggregators by occupation, and we like creating useful information. And so to the extent you like some basic elements of this, but you also think there's something that could make it even better, we're all ears. And so with that said, let's go ahead and dive in. So just to give you a sense of structure, it's pretty straightforward. It's got an executive summary, which is handy, right? It cuts to the chase about some key elements. It really is broken down into two sections, if you really think about this. And I'm going to explain those a little further here in a minute. But there's the risk radar, which is specifically honing in on certain risks. And it allows you to track the movement of risk quarter over quarter. And it aggregates those risks to create a risk profile. And we'll walk through that in a second. The second part of the report is what I would characterize as much more of an operating, strategic, and risk management tool. This really says, from a risk management and a performance standpoint, I have interest in 4 key categories of my bank. I want to look at growth and earnings, for example. I want to look at the fundamentals of the business and our asset quality. I want to look at deposit and loan growth. I want to always be mindful of my capital adequacy and liquidity. So we'll roll into that. Currently, there are 179 CDFI chartered banks. So for those of you that were interested or curious as to how many banks are actually chartered, there's 179. Now, what you'll notice when we get into the performance section, and I'll say a little bit more about it when we get there, is we've also tied in your UBPR group. And what's neat about that is when you start looking at the key trend charts, yes, you're comparing yourself to CDFI banks, and you might say, hey, that's not my only consideration. But it also ties into your UBPR assigned group. And I'll mention that a little bit more in detail here in a second. So let's kind of get our head visually around some of the key things. So I mentioned there's 2 components to this report. There's the risk radar, and that's that image that you see to the left. And I'm going to hit the bullets first, and I'll talk a little bit about its use. It is a heat map, and it reflects your bank's relative risk compared to all CDFI banks. And there's 10 elements to this report that it's looking at. It's looking at ROA. It's looking at net interest margin. It's looking at non-interest income. It's looking at tier 1 leverage. It's looking at non-performing assets, ALLL levels, net charge-offs, 30 to 80, 90 days past due, cost of funding earning assets, and loan to deposit ratio. And so if you think about it, so those 10 items are now being viewed with your bank along with those 178 other CDFI banks. And on a relative basis, it's plotting you to a point of saying, are you in the high, much like the UBPR report is designed, it's broken out into deciles. So if you see this score line, and we'll get into this in a little more detail as we do the review of the report, but that score line is taking the aggregate score of your bank and implying a risk profile. And so it's kind of a handy way to say, these are the moving parts. And you can see there's two things actually going on here. So if you look at a specific line, like this first line is ROA. So that dark green line suggests you're either in the top 10 or 20% of the aggregate group. And that's out. So you are looking, so that color coding is where you plot against the peer group. But where you see those trend lines, those arrows to the right going up or down, those are indicating your specific movement in that example. So if we look at that ROA line again, so that's basically saying, hey, you're coming at a 185 ROA, which is awesome. And you're in the lowest possible risk category, which puts you in the top decile or so. But you're trending down over the last reporting period. So internally, it's trending down, though it's still very favorable. Okay, and vice versa. You can have something, for example, go down to this very bottom list, which is loan to deposit ratio. And you can see this bank runs hot, 99% loan to deposit ratio. So it's in that lowest decile. So from a relative risk standpoint, it's a higher risk rating, but you can see it's trending in a favorable fashion because it's lower than what the loan to deposit ratio was in the previous period. So as you look at this model skews heavily towards credit, which is what our normal bank clients are skewed to. So you have things like non-performing assets, ALLL, net charge-offs, 30 to 80, 90 days past due, make up half of the assessment. So that's how the weighting comes into play. And we'll get into more details, but that gives you kind of this sense of the heat map and the risk radar. So that's one piece of the report. And I'll show you how we detail out the following or the subsequent elements to that in just a second. Now, when we look at the performance and risk trends analysis in the report, that gets into a little different perspective, right? So, and again, just hitting the bullets, it measures your key performance or risk trends compared to all CDFI banks, as well as your UBPR group. So when you look at this particular chart, you're looking at, again, an ROA, and in this example, it's a favorable. So it's performing above the peer group average. So that renders it favorable. So you can see the bank's trend line. You can see the CDFI peer group trend line. But now you're also seeing your UBPR group, which gives you that broader strategic context, right? So quite a bit of information per chart. Your trend, the CDFI peer group trend, your UBPR peer group trend, and whether it's a favorable or unfavorable variance. Now, the thing to point out there is it's favorable if you're above the average. It's unfavorable, sorry for the term, but it's unfavorable if you're below the average. So you can see in this example on non-accrual loans, this bank is running higher than both the CDFI and UBPR peer group averages, thereby rendering a red indicator. Within the report, it does break out into 32 key performance and risk indicators. So there's literally 32 of these key indicators, and they're broken out into 4 categories. So you've got growth and earnings as one category. You have fundamentals and asset quality as a category. You have deposit loan growth as a category, and you have capital adequacy and liquidity as a category. And I just realized it's not in the bullets down there. We'll make sure in your copy of this it is. So 4 groups: growth and earnings, fundamentals and asset quality, deposit and loan growth, capital adequacy, and liquidity ratio. So let's do a little deeper dive. Oh, and by the way, one of those things that we learn in life is just because we're good at something doesn't mean we're not taking risk. And one of the things that's always good about looking at aggregate data is understanding we can take greater risk. We just need to have greater controls. And effective risk management is not about risk avoidance. It's about risk control. So all of this is designed with that in mind. So I'm not necessarily concerned when I see a lot of red on a report if I see green where I want it to be. And keep that in mind as we go through some of the examples. But let's talk a little bit more about that risk radar. And again, this is a composite view of your bank, and you can see how it lays itself out. So the rating table below, low risk is given basically points, and you're kind of in the top two deciles. I'm rounding there a little bit. Low moderate would be a 3 to 4 point getter, and that puts you in kind of that 30 to 40 percentile range. Moderate puts you right in the middle. Moderate high puts you out there towards the 65 to 82 percentile, and high is in that 83 to 100. So to take that high consideration, in this example, when we look at net charge-offs, you can see this bank is kind of systematically moving through weakening in its net charge-offs. Where it was low at one point, it got a little higher in terms of what the charge-offs were. And what's happening, so not only is their trend changing, now it's flat here because it stayed the same quarter over quarter, but it went red because basically the overall net charge-off of the entire aggregate group got better. So even their 11% actually increased their perceived level of risk on a relative basis. So think about this in terms of when you look at each of these key risk categories, you're getting a chance to look at your own trends. You're getting a chance to interpret how you're trending within the peer group. And you have a leading indicator suggesting which way is it going. And as I mentioned before, if you see these points in each category, what I really like about what this heat map does is it aggregates these performance-related risk categories, and it summarizes it into an overall risk profile. So you can see this bank at one time was running low moderate. Their earnings were strong. Their ALLL levels were strong. Their net charge-offs were strong. Their 30 to 80, 90 days past due were strong. Cost of funds, middle of the road. And hey, they like to run a little hot with loan to deposit ratio, and nothing wrong with that. That tends to drive up earnings. But you can see in aggregate, that kept them in kind of that low mod. But with that progressive weakening in some of the key credit indicators, which we see there, also in their capital indicators, that pushed them out. Again, not necessarily a bad thing to be moderate, but there's a risk reward scenario there. And so with that said, Bob, any thoughts before I go into a little deeper?
Yeah, and this is the heat map that I was referring to earlier. When you get this report, you know, if you look at that, if you'll go back, Jeff, to that.
Oh, sure. I'm sorry.
That's all right. If you go back to this, I mean, very early on, you can take a look at this. Not only can you see the composition of your score in each of the quarters as you go down the table, but as you go across the table under that risk score, it helps you immediately focus in on how the trends are looking for the institution. And if you see that number going up, it should immediately give you some indicators of things that you need to be looking at, how you are managing and unaware of that risk. And I think, Jeff, you might expand on this. I think, as you pointed out, risk in and of itself is not a bad thing. Uncontrolled risk or unidentified risk is where people get into trouble. And when you see risk on these scores, then your immediate thought process, well, how are we dealing with that? How are we managing it, mitigating it, or offsetting it through other methods? And it helps a management team really make their time very efficient. So that's kind of my takeaway as we look at this, because the trends as well as the composition.
And just a quick comment, I was going to bring up another one of my clients' radars because it's really interesting. When you look at literally the bottom 5 categories, which would be ALLL, net charge-offs, 30 to 80, 90 days past due, cost of funds, and loan to deposit ratio, all 5 of their categories are solid red. They run super hot on loan to deposit ratios. Their cost of funds isn't all that appealing. They tend to run a little higher in credit quality issues. but they're pricing in their risk reward. So when you look at their ROA and ROE, or I'm sorry, their ROA and net interest margin, they're super strong. They have a good stream of non-interest income. And all of a sudden you see this balance of, hey, they've priced in the risk reward condition so that they're running pretty hot in certain categories, but they're showing the sustainability of above average growth, making that level of risk worth taking. And it's nice to see that in a single snapshot, especially if you're sitting down with a board member saying, I don't like, they're saying, I don't like red. It's like, well, you know what? Sometimes we take on some red in a certain category in order to drive sustainable growth or sustainable earnings. And that's the nice thing about having a report that consistently facilitates these types of discussions. And just to do a little deeper dive as it relates to the risk radar, and then we'll move to the performance report. So the risk ranking scores reflect your placement. So once you look at the heat map, you can go in and look at the details. So you can look at ROA, you can look at ROE and see just how you're moving against that CDFI group. And if you've got a nice trend line in one direction or another, but what's really nice about each one of these individual snippets or captures of the charts is, again, it shows you your trend and how it's moving across your low to high range, if you will. And you can see in this example, that's this bank's net interest margin is just, though it's trending down a little bit with the peer group, it's a very strong net interest margin. You see that 2-point rate number there. But the big thing I just wanted to show you here is that you can go in if somebody says, so what's up with ROA or what's up with net charge-offs? And by the, what's up with our capital levels? You can peel back the onion deeper and look at the trend. And if you'd like to see this year over year versus quarter over quarter, you just let us know and we can flip the switch and show you that as well. And you can see in the table, it's your bank as well as the CDFI peer group numerically as well as illustrated through the chart. So with that, let's go ahead and jump into the performance and risk trends comparative. So I love this page. And it's just providing you. So this is the bottom half of the executive summary. And if you recall, I said there's 4 components to this report. There's growth in earnings. There's growth in earnings, fundamentals and asset quality, deposit and loan growth, capital adequacy and liquidity. And so within that, what this does is this takes all 32 and says, if you're wondering where you plot in each one of those key categories, it gives you your 5-quarter trend. It gives you the peer average in the most recent report, and it kind of spits out a variance. And so you can see both in terms of, so for this bank, the top 3 growth categories, they're I don't want to use the term outperforming, but they're performing above CDFI peer group average. But in the red cases, it would be you're performing below the peer group average. What's kind of neat about this type of example is are you green where you want to be green, and are you red in areas that either is justified or not, right? But green is just kind of a positive indicator you're above average. The red is, you're below the average, but that might be okay. But what's really nice is you can just let your eye run down the list, whether you're looking at asset or loan or deposit growth, if you're looking at equity levels, ROA and ROE, cash dividends, net income per employees, right there in terms of those are your growth and earnings categories. You can see then it rolls into fundamentals, which includes net interest margin, efficiency ratio, non-interest income, non-interest expense, asset quality, NPAs, 30 to 80, 90 days past due, 90 plus non-accruals, deposit mix, right? Demand deposit growth, all now accounts growth, other savings, moving into loans. And this is where some of you might say, hey, I like the structure of this, but you're kind of hard coding construction and land development, 1 to 4 residential, CRE and C&I. You might not do any construction and you feel that's wasted real estate, and you might want to put small business loans. You might want to put some other factor, but this is pretty good. And then again, capital adequacy. all four ratios. Now, if you've opted into CBLR, that's fine. But what's really interesting, and I'll show you in the detail, is when we look at capital, for example, many of you who may have benefited from that excess liquidity over this last COVID period and may not have had the loan growth you're looking to achieve, may have, upped your investments and your securities portfolio. And hopefully you're relatively short. But in the near term, if you're not, I'll just skip to kind of the capital adequacy. So if you look at this particular bank, their leverage ratio, which is their total capital position, dropped, and that's because of the mark to market as it relates to their equity position or their total capital. But anyway, back to the report. You've got those key capital considerations as well as liquidity. And in this rising interest rate environment, we are starting to see movement. And and we've all experienced this, right? It's in a rising interest rate environment, that's generally good for us. But somehow, deposits might precede when we get to see an increase in the yields. And so there's a bit of a lag effect. And with this weakening economy, we're also seeing that the competitive landscape is still stayed pretty high. So unfortunately, we're kind of seeing this compression, right? So we'd like to raise rates, but we're all fighting over the same bone. But now we're starting to see those depositors say, you know what? The paper keeps telling me interest rates are going up. Why aren't they? And so we could be faced with that conundrum, right? And deal with some compression. Anyway, my point on this particular one, you got a good variance report. It's a nice snapshot right in the executive summary. And if you want to just take a quick down and dirty, it's a great summary sheet. Now, as you get into the report itself and do a deeper dive, I talked to you about the categories. I'm just going to really go over the pages. And so when we look at growth and earnings, you can see these first four are asset growth, loan growth, deposit growth, and bank equity capital. Now, here's what I was talking about. Look where everybody went with bank equity capital because of that mark to market. Is that a crisis? Probably not, right? All it's reflecting is unrealized losses. Now, to the extent you happen to be materially long in your securities, there could be a bit of a challenge there. For those of you that might be a California bank, the state regulator here wants to add AOCI back into tier 1 leverage, which is a little scary. But the point is, if you've gone particularly long with those securities and they're not falling off at a rate you might like, and interest rates go up, you could be forced with not having necessarily that option because where you are on that security to move it off your balance sheet. So that could add some additional pressure on margin compression, at least in the near term. But what's interesting is to just see how clearly that's illustrated, both with this bank where you can see their equity drop that degree, as did the group. And
Jeff, just a comment here. One of the things that banks need to be cognizant of, their liquidity plan, if they have built into their liquidity plan that they're going to utilize the investment portfolio for liquidity purposes, when the regulators begin to look at it, they're going to say, well, your plan says that you're going to use liquidity to fund your loan growth that you have in your budget. Well, if you're going to be funding it, then you're going to be realizing those losses. And so it creates a difficult conversation because you can't legitimately say that we're going to be patient and just ride this out because we have, the balance sheet. Because if you've on record, and this is where having all of your various strategies and plans come together and making sure that they fit together, because this is one of those things that changes, which means that the liquidity plan probably needs to be updated to reflect the reality of what the amount of compromise in your portfolio.
Now, interesting. Thank you, Bob. Great point. I'm sorry, and this dawned on me too. For those of you who received your ESIP money during Q1, which many of you I know have, you would have been an aberration to this trend line. Because if you picked up somewhere between 50 and $200 million, that's going to be, that's going to spike up your total capital. But you can see, even with those of you that received the ESIP money, it did not reduce the blow to total capital as a group. And that's just a function of the numbers, right? But well, right on, Bob. And the other comments I'll make too, I wanted to just drill into what you'll be able to see in this report. But when you look at each chart, again, you are the gray bar, and you are the first data line. The second data line is your CDFI peer group. So that's those 178 other banks plus you. And then your UBPR peer group that you're assigned to. And so you've got three nice pieces of data. And then what creates this green or red bar is where you are in relationship to the peers average. So you can see it's green here on asset growth for this bank, but you can see it's red here because their capital dipped lower. It's red here because we did include net income per employee, and you can see they're running below peer group average, and that's the red indicator. So that first group, growth and earnings. The next group, fundamentals and asset qualities. And fundamentals, just what you think they are, right? We're looking at our net interest margin. We're looking at our efficiency, non-interest income, and non-interest expense. So those are kind of the fundamentals that we're zooming in on. From an asset quality perspective, we're looking at non-performing assets, 30 to 80, 90 days past due, 90 plus past due in non-accruals. And again, you can see in this bank's case, their non-accruals are running a little hotter than the rest of the group. And that's what the red indicator reflects. Rounding out, and again, if you think about it, this report is 5 pages. It's not a whole lot, but there's just a lot of stuff in there. So when you get to deposit and loan growth, now it's peeling back the onion. Are you where you want to be in that demand deposit growth? Are you pursuing those low cost relationship-based deposits? And how are you doing relative to the group, relative to your peer group? So when we talk about deposit and loan growth, we're starting to peel back the onion a little bit, right? So we're showing demand accounts, all now and ATS growth. We're looking at money market activity, and we're looking at other savings. So those 4 groups represent the deposit side. On the loan side, again, we're looking at construction and land development, so CLD, 1 to 4 residential, CRE, as well as C&I. So again, it's kind of the big chunks of the portfolio, but a very nice mechanism to watch the movement of this activity in those specific growth categories. Probably really interesting for you all that are ESIP recipients. Again, Treasury is probably going to be interested in how you are doing in relationship to CDFI banks. You're going to know if you're looking to accelerate the deployment of that capital, you're going to be able to kind of gauge yourself against where the group is. And that might just be an additional data point, though maybe not required for reporting purposes. When it really comes to growth, you'll be able to kind of keep a CDFI perspective as well as a more strategic UBPR perspective. The last 2 categories within the last page is capital adequacy and liquidity. So you've got your 4 capital ratios, you've got your liquidity ratio, and you can see even in first quarter, which really didn't show any sign of weakening yet from a liquidity standpoint. I know Q2 is looking a little differently, but we also have loan to deposit ratio from a liquidity standpoint, net non-core funding dependence, and then lastly, broker deposits. So again, a nice aggregate group of different categories that provide you the ability to look at how you're doing, look at how other CDFI banks are doing, look at how you are doing strategically against your UBPR group. And then a quick snapshot variance-wise, is there red or green on your chart? Is that okay? Is it a trend? Is it an aberration? Is the green what you want to be green, and is the red something you're not overly concerned with? So a nice simple way to review it. Bob, before I kind of throw some closing thoughts out there, any other comments before we wrap things up? And actually, I know Robert's on with this too. He can also.
In your opening comments, you mentioned about using these reports in conjunction with your asset liability and ALCO processes. And I think that's a very important point to emphasize, and particularly as we keep emphasizing. And by the way, I guess everyone knows the Fed did raise 75 basis points. You've got to go back and revisit your assumptions in your ALCO report, because this report is going to give you a retrospective look, and you can follow the trends to see how things are coming out of the past and into the future. But when you marry this with your ALCO report as a forward-looking tool, you get some really good intelligence about managing the company. And as we said at the outset, the color coding is something that a lot of people like, because it does help call your attention immediately instead of just a bland data table, which often just overloads the senses in what you're doing. One last thing, Jeff, and I think this session that we're hosting today was a direct result of feedback from CDFI banks through Nisha at CDBA that, I'm not sure everyone realizes that CB Resources in producing that peer performance report for what now over 10 years, I think, Jeff, that been working with CDBA. And so the interest that the firm has in this important segment of the banking industry has deep roots. And, I think that is evidenced by this report and some of the other data that we're providing. We're very committed to helping these institutions perform well, because we all understand that we need all CDFI banks to perform well. This is a really important time for the industry, because a lot of focus and attention has been brought on it with the resources made available to it. So we hope this tool helps the banks execute their plans and is useful in their day-to-day operation. And I know, Jeff, you're going to be open for questions if anyone wants to explore any more details. So thank you.
You bet. You bet. My closing thoughts is more in kind of from a global perspective. We've been somewhat occupied with rising interest rates and inflation, and if we're not in a recession, for those of us, I kind of think we are, but if we're not, we're really close. We've got a ton of global unrest, and those factors are going on around us. But on the other hand, from a CDFI perspective, I don't know if market conditions have ever been better. For those of you that have taken advantage of VSIP money, fantastic. That's a chunk of capital that is almost hard to conceive from a capital markets position. When you think of the social focus we're seeing our country, if not the world, move towards, I don't think there's been a better time for CDFI banks. And I don't know, for some of you that might have been at the CDBA conference, CDFI chartered banks in terms of size numbers have doubled and tripled in size. There were 10 years ago, there were 7,500 employees in CDFI banks. Today, there's 15,000 employees in CDFI banks. So market conditions have never been better. And I think that underscores the opportunity for growth, even in tougher times. But I do think that as you grow in size and or complexity, continuing to look at how you adopt a process to support your ability to identify, measure, monitor, and ultimately can control your risk is key. And so I hope in some small way, this report will be added to your quiver as a nice summary document that gives you some useful nuggets that just may not be out there in the market. And by the way, if they are, please let me know, because we've done a lot of research in that. And things like this are useful in good times and bad. So that's kind of that. By the way, before we go to Q&A, there's always a pitch, right? So we do have a good number of CDFI bank clients, and the most recent feedback says the reason they like us is they really think we have the best board management, risk tracking, monitoring reports, that we are really good at integrating our strategic capital and risk management solutions to help our clients operationalize management of risk and performance, that our stuff really works well with regulatory communications, that we have a flexible and scalable platform. They like our analytics and they like our subject matter expertise. So you've just witnessed my commercial for the company. I hope you'll all consider that. So with that said, and Robert, you could jump back in after Q&A if you want to add another sales page. But any questions or comments regarding the report? I think, Robert, if I'm not mistaken, our participants can comment or ask questions through instant messaging.
That's right. The chat function is below.
And you can also use the chat function if you would like a copy of this presentation, either recorded version or otherwise. Okay. All right. Well, clearly I did a really good job, Bob, or you did a really good job walking through the report. You know, with Bob joining our team, we really, I can't tell you how excited we are, is focusing a good deal of our resources and attention to serving specifically our community development bank clients. So if I leave you with nothing else today, it's an area that we are committed to. It's an area we share a lot of common beliefs as it relates to impact. And if there's something about this report that you think is valuable, but it may be not quite hitting the mark, please share that with us. We're in it for the long run. We've been generating reports for CDBA, as Bob mentioned, for over a decade. And we think we've just started scratching the surface on how we could add value through data aggregation and analytics. So with that, I want to thank you all for taking time out of your busy schedule. And don't be a stranger. And we look forward to hearing from you real soon.
Thanks, everyone.